love the channel and find it useful in becoming a happy retiree. Subscribe today. We're going to start with Ed, who joins us from Lawrenceville. Ed, what's going on? How can I help?
Good morning, Wes. Enjoy the show.
Thank you, sir.
Been listening since Mike was the host.
It's been a long time. That's a long time, my friend.
Yeah. We got a small holding of General Electric. It's probably less than 4% right now of our portfolio. And the main reason we're buying it was low back in 2010, and it's a dividend-paying company. So just looking to hold it for the dividend payment, to have a little bit of spending money in our retirement. My wife's retiring this year. I'll be retiring a year from now, and also later on passing it on to the grandsons. But my question is there still a reason to invest in GE? There's been a lot of news about it, their business being off and things of that nature. So,
GE is a tough one for a lot of reasons. I mean, I remember when GE was, and back when I remember in the early when I first started hosting Money Matters in I guess it was the beginning of 2009 when GE dropped all the way to $6 a share, and again the rest of the world was almost had fallen apart completely. The S&P 500 at one point was down 56%, and it was just a disaster for almost every stock out there. And GE was caught up in the storm, and then had this. I remember at $6, it looked like I remember taking calls, I think, in GE and thinking, what a wonderful opportunity to buy GE, and it obviously did very well for a number of years, much like the rest of the market, and then has come kind of cratered back down to earth today at $13. And GE is to some extent a mystery. It's hard to wrap your arms around how badly their stock has done relative to all the other business lines that they're in. If you think about what they do, and you think about defense. I mean, they make engines and they're in aeronautics, right? Yet defense industry has been an absolute skyrocket higher. Look at any defense stock. Look at Lockheed Martin. Look at Raytheon. And so the defense industry has been great. They're in healthcare. They're in healthcare imaging, and healthcare has been on fire for years. They are in the utility business. I mean, they make parts, and they're huge. They have a huge share of the utility market. Again, I wouldn't call that a giant growth market, but again, pretty darn stable, and the utilities have done very well. They own Baker Hughes now, and the energy sector that has certainly been cyclical. The energy sector has come back, and oil prices have stabilized much higher than where they were a couple years ago. Yet GE can't seem to find a bid. Part of what is happening with GE, and now you're talking about this, what used to be a massive company, now the market cap of GE is all the way down to around $100 billion, which is tiny compared to some of these other companies we're talking about today. I mean, look, we talked about Facebook's market cap of $450 billion. That's 4 times the size of General Electric. Yet General Electric is in all these wonderful growth areas, or stable areas at least. It's really the skeletons in their closet, or the ghosts of their past, that are a huge reason that it's been such an awful stock. They had to cut their dividend, and a big chunk of that has to do with their finance business and their insurance business. I mean, they're one of the leaders in long-term care, and just had to take something like a close to a $10 billion write-down for that. I mean, that's the kind of business line that you can have all these other things going relatively well, and it brings down the whole ship. So the way I look at it as that there's been so much bad news and so much bad press and so many visible areas that have gone wrong for GE, that you have a classic value type stock. Now you've got to be relatively brave as an investor to go in and buy a value stock when things look bad. But remember, when you're an investor, that's when things can ultimately go well. If you go in, you have patience, and you say, well, look, everything has gone wrong for this company, but they're still in a lot of decent business lines. and they've got a lot of good people, and they've had to right-size that ship too. But will they climb out of this hole that they arguably dug themselves? And will they get out of this hole over the next 3 to 5 years? I think only time will tell on that. But Ed, my take on that is where you see the stock today, even though they've had to cut the dividend once, and they might even have to do it again, you still have a pretty decent yield here moving forward, close to 3.5%. That's even with the cut dividend. And do they climb out of this kind of nightmare scenario that they have created for themselves? I would not be surprised if they're able to do that. I think that they certainly are able to do that. And as long as GE isn't 50% of your portfolio and it's just part of a diversified portfolio, like what you're saying, and it's a smaller piece of the pie, then for me, I think it's okay. I think it's okay, and I think patience will ultimately will pay off. But again, I don't have a perfect crystal ball, but my thought is that I could see them certainly eventually turning this ship around. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.